Well, good morning, Jagendra Rana here. Investing in an overseas house property. This is the topic of our discussion today. Investing in an overseas house property. You are aware of advantage. Indians are increasingly investing in real estate overseas. Even salaried individuals are doing so, driven by factors like children studying abroad and investment diversifications. So, for resident individuals, such purchases are governed by RBI's liberalized remittance scheme, that is called LRS, liberalized remittance scheme, which allows outward remittance of up to $250,000 per person in a financial year. Families often pool individual LRS limits to fund a single acquisition. Payments may be made in installment provided each remittance stays within the annual cap and is routed through authorized banking channels. The proper documentation is essential to avoid violations under Foreign Exchange Management Act 1999, that is called FEMA, Foreign Exchange Management Act. So all foreign assets must be disclosed in Indian tax returns in the prescribed manner. Non-disclosure of foreign assets can trigger implications under the Black Money Act 2015, including substantial fines and prosecution. Rental income, whether earned in India or overseas, is taxable in India. So for tax residents, overseas rental income must be reported even if taxed abroad. Though relief in the form of foreign tax credit based on residence may be available for any doubly taxed income under the relevant tax treaties, double taxation avoidance agreements. So interest on loans taken to acquire overseas property can be claimed as a deduction subject to specified limit. Now foreign tax credit is explained here. Under India's tax treaties, residents can claim foreign tax credit to avoid being taxed twice on the same income. For example, if an Indian resident earns rental income from a property in London, that income is taxable in India due to his residential status. Since the UK also taxes such rental income at source, the taxpayer can claim credit in India for the UK tax paid, so against the Indian tax payable on the same income. This mechanism ensures that the income is effectively taxed only once, broadly at the higher of the two tax rates. Of course, proper documentation, including proof of taxes paid in the UK, is vital. Now, what happens on sale of property? Capital gains from overseas properties are also taxable in India. For residents with tax ready relief by way of foreign tax credit, helping mitigate double taxation. So this is the system of investing in an overseas house property, because the rules applicable on such transactions will alarm you. Provisions of Foreign Exchange Management Act 1999 will apply. Black Money Act 2015 will apply. And the proper documentation is required to prevent yourself from double taxation. Thank you very much.